If you took the entire market from the beginning, let's just say that, whatever the date was of the Dow Jones, I used to have it in my head. I don't have it right now. If you took the entire market, because we're so used to looking at charts and seeing ups and downs, if you took the entire market, everything that has ever happened from the day the Dow Jones opened right up to today, but printed all of that as a single price bar, it might look something like this. With the market way up here. This is the entire history of the market printed as a single price bar. Have you ever thought of doing that? You take all the different fluctuations out and you just say, here's the date it started, and we don't even have a second price bar. It's like a 100-year chart. So this is bar number one, and this is about where they would be, or they'd even be higher, right? Because if I drew it as a candlestick, which I'm going to have difficulty doing, it would look something like this, because we are up at the right, pressed up against the highs. Maybe there was a little bit of a, I can't get my cursor to go between those lines. So that would be the wick on the bottom. There'd be no wick on the top, basically. This is the entire history of the market in a single price bar. There you are. So doesn't that make your mind work a little bit when you think of all the movement, all the different little things that have happened inside that market? And if the price bar was, say, 100 years or whatever, and then at some point you'd be beginning to print a new bar, and that would be the second bar on your chart. So the funny thing is, though, is that when you just say there's only one price bar, this is the whole market. This is everything the market has ever done, all in one price bar. Daniel's here and he says, but if I do win the lottery, I'll make sure to invest it in some kind of index fund like the Dow Jones you mentioned. That's a great idea, but you don't, and thank you, Daniel, you don't have to win the lottery to be in a very good position once the index does have a substantial pullback to begin being an index fund purchaser on regular timed periods. Yes, it's better if you know certain things about the market, then you could time it maybe even better. But let's just put that aside. Let's just say that the average person, without winning the lottery, particularly if he's not, shopping at Forever 64 like I do, let's say he's younger. So he starts at some younger age, and he is going to be investing every quarter or every month or every 6 months, whatever he's going to do. He's going to take some money and he's going to say to himself, there's things I want to do with this money, but I'm going to put it into the index funds. And if he keeps doing that every period of time, he will end up in a tremendous position later. Unless the entire system collapses, and there may be some chance that that could happen sometime, right? Don't you feel a little like that? It could happen. But unless that happens, system meaning the whole bloody thing, United States, just collapses, then, he could be in a tremendous position later in life, a person that does that, because the indexes, as you know, indices do tend to go up. They, stocks that are companies that are not doing well are delisted, and other companies that are, their star is rising, ascending. And so therefore the indices, even though they have their pullbacks, tend to continue moving higher over time. So I like that as a mechanical way to build wealth.